All right, good afternoon, everyone. Thank you for joining. This is Eric Underwood from Basis Climate. I have Durham McCormick from McGuireWoods and Brandon Hill from CLA on the line. We're gonna have, I think we have, I would call it quorum in the attendee group right now. So I will just take it around. I'll let the co-host and myself, we'll do some introductions, and then I will go into the agenda briefly, and then we'll kick it off from there. And we have on the On24 platform a Q&A chat functionality, so please do send your questions through Q&A. We will be monitoring those, trying to respond to them live as well from a sort of conversational standpoint, but then also reserving time at the end to make sure that any additional Q&A that we haven't addressed or topics that we haven't covered can be addressed during this hour. So thank you very much. So by way of introduction, Eric Underwood, co-founder of Basis Climate. We are a tax credit transfer platform focused on expanding this amount of buyers and transactions possible through tax credit transferability. We've been around for 2.5 years, founded very shortly after the IRA was enabled tax credit transferability. Excited to see existing and hopefully future clients on this call, and really excited to have this opportunity to speak with Durham and Brandon today. Durham, why don't you go next?
Yeah, thank you, Eric. I'm Durham McCormick. I'm a partner at McGuireWoods, a tax lawyer here. I'm in our Houston office. I'm co-chair of our renewable energy team. I've been helping clients in the renewable energy sector my entire career. So over 20 years helping clients build and transact around solar, wind, geothermal, energy storage, all types of technology. I like to kind of summarize myself as a tax lawyer that lives and breathes electrons. That's kind of where my focus is. Really excited about this presentation and the chance to talk with everyone about what's happening in 2025, particularly in light of what's happening in Congress with the One Big Beautiful Bill. We'll touch on that a little bit as well. But at this point, I want to turn over to Brandon and let him introduce himself.
Thanks, Durham. Hi, everyone. My name is Brandon Hill. I'm a tax principal with CLA. CLA is a large public accounting firm. I lead CLA's energy tax services practice, so that encompasses a variety of different areas. But in particular, we're participating in a lot of tax credit transactions, both on the sell side and on the buy side. So really glad to be here today and looking forward to diving into all the kind of fun topics and current events. So with that, I'll kick it back over to Eric.
Thank you, Brandon. So for the agenda, I think, what is top of mind for everyone is the budget reconciliation process that is occurring. So Durham will lead the conversation on that, but it will be a conversation, and happy to get specific questions. Again, none of us are in the circus with the tarot or the crystal ball, so we don't exactly have the answers, and we are monitoring our phones and email inboxes live, as I think everyone on this call is. But excited to dive into some of the details and really dig into some of the major changes that we've seen in either the House or Senate texts that have been proposed today so far. Then I think we're going to have Brandon go ahead and give us some conversation around what are buyers looking at in terms of how they're approaching tax credit transactions. We're at a point in the legislation from the IRA that more and more buyers really were starting to include this as part of their tax credit strategy, and so diving into some of the more fine details on what kinds of volumes they're looking at and how they're approaching that with their tax liabilities. And then we're going to have a further conversation really talking about what are the dynamics and the commercial sticking points that are happening in transactions. What are we seeing? What types of transactions are each of us seeing right now? As well as how are buyers starting to think, looping back to the big beautiful bill, or as we call it at Basis, the not so beautiful bill. But what are buyers thinking about as they're looking at both transactions for the remainder of 25 as well as 26 and beyond? And of course, as I mentioned, we'll save some time at the end for questions. So with that, I will advance the slide for you, Durham, and let you kick off the summary of changes. And then you can advance or unadvance. Yeah.
Well, I mean, to build on what Eric was saying, I mean, none of us here have a crystal ball into where the BBB ultimately might sit. But here, what we have in front of us is kind of a table that shows how the bill has kind of advanced since May 12th, which wasn't that long ago when the first draft came out of the Ways and Means Committee of the House. So there's kind of three different milestones we look at right now with the BBB, which was the initial draft of the House, out of the Ways and Means Committee, and then what came out of the House itself was even modified more on only 10 days later. And then most recently, about just over a week and a half ago, the Senate came out with its own version where I think it puts us from a timing standpoint is we've all been, well, the first part of this week, we've been expecting the Senate to publish some updates to their version of the bill this week. So we were expecting it to come out today or even tomorrow. Who knows? We don't have a crystal ball. It might be more like Monday now, but we do anticipate some additional tweaks. And what we're going to focus here on is the stuff that's impacting renewable energy projects in transferability, things of that nature. The highlight under the BBB for renewable projects is that really the runway for qualification for the PTC and the ITC under the new sections, which are 45 Cap Y and 48 Cap E, which I commonly refer to as the clean tech ITC and PTC. The old ITC and PTC, which was under just the normal 45, section 45 and 48, remain unchanged, but they expired for projects that hadn't already begun construction before the end of the last year. So the rules for those projects that had begun construction last year or earlier remain unchanged. It's the newer projects that qualify under the new clean tech ITC and PTC is where the legislation is focused. And before the BBB came out, those ITCs and PTCs were available for projects that began construction all the way through 2033 or later if it was based on a phase out starting in 2033, or it could have been later if the net reduction in the generation load on the U.S. electric system grid had not been reduced by at least 75%. So going down to a 25% of the 2022 levels, which was the year that the Inflation Reduction Act was passed. So what the BBB was doing or is doing is shortening that runway. And when Congress came out with the May 12th draft out of the Ways and Means Committee, it was using both, really a placed in service deadline for phasing out the credit starting in 2029, which is much different than our current begin construction deadline. But then when it ultimately came out of the House, it even shrunk that runway much, much more. You had to begin construction within 60 days of enactment of the bill. And then it had this additional placed in service requirement by the end of 2028. Although technically the way it was drafted, that never even really became applicable because it only applied for projects that began construction after that 60-day period, which you wouldn't qualify for the credit anyways. But that drafting issue became moot because the Senate came out with its own version. And the Senate's version is simply scaling back based on the current begun construction standard. And so any project that begins construction in 2025 or earlier would still get the 100% PTC or ITC, and then it starts to phase down to 60% for beginning construction in 26 and 20% if a project would begin construction in 27, and then nothing thereafter. Now, there is an exception for large wind projects that are on federal leased land, but that's over a gigawatt of capacity and has to be at least 25% of the installed capacity on federal land. Then they would be exempt from these phase outs. And I do want to emphasize these phase outs. So Congress is only looking at two technologies, and that is wind and solar. So these reduced runways for ITC and PTC qualification are simply for wind and solar projects. All other tech neutral that are zero emission energy production would still qualify for the ITC and the PTC under the current law, which is, once again, through that 2033 runway. The one exception is the BBB will eliminate the ability for qualification to extend past 2033 for the electric grid not being reduced by at least 75% of the 2022 emission rates. So it's a hard step down now starting in 2033.
Just jumping in right there, Durham, I think one of the most challenging things is these are, of course, the two most mature clean energy industries in terms of excluding hydro, perhaps, but the wind and solar are the ones where we've seen the most dollars flowing, the most well organized and momentum building, particularly in the solar industry. Why do you think the Senate has focused on those in terms of a scoring method or in terms of trying to strike a balance here?
Yeah, I mean that's a great question. I mean, and also in addition to those are really also the two technologies where the vast majority of new load has been built on the grid in the United States through wind and solar projects over the last really 10 to 15 years. New generation has been focused on those, not only because the tax credits have helped make that economically feasible, but they're scalable now. Also, the ability to get them constructed in a reasonable time frame. I mean, I don't want to use like the erector set analogy, but somewhat close to that. It is a lot easier to permit and construct wind and solar facility clearer than nuclear. Hydro, but it's definitely much easier. Even combined cycle gas turbines, they can kind of go up faster. So there's that benefit to the electric grid as a whole of scalability with wind and solar. But to answer your question directly, why is Congress looking at those as scaling back? Well, probably two primary reasons. One is the pay-fors. Everything in budget reconciliation is about pay-for. So, for instance, to help pay for this, allowing the salt cap to go up, where are you going to find the money? Well, one of the low-hanging fruit is from the IRA, and wind and solar is kind of part of that mix. The other natural, I think, discussion point is, are those technologies advanced enough to where a federal subsidy is no longer needed? Is the industry established? I mean, I think that's a natural kind of conversation piece. Whether that's true or not, I think is debatable. I think that the U.S. electric market needs incentives for scalability, for increased demand, for load growth that we're going to see in double digits foreseeably over the next decades. There are other benefits to being able to get more load on the system right away. But I think wind and solar are an easy way to get the pay for, an easier path forward to get the pay-fors, and because of the more established nature of these technologies, it's an easier discussion point within Congress.
Gotcha. Okay, I know you've got some more slides, so I'll jump to the next one and let you continue.
Really, the meat of what's happening with the BBB is in wind and solar, but we also want to just kind of highlight some of these other credits that are still available. So, the zero emission nuclear power PTC, that's for existing nuclear power. That's impacted. The net result is the House version was haircutting it, not as dramatically as wind and solar, but haircutting it slightly. But ultimately, the Senate took it back to 2031. So I think it's a 1 year shave off, maybe 2 year shave off of the existing IRA. Not much of a meaningful change, not really kind of like in the moment, like we need to do anything, but something just to be aware of with respect to nuclear generation. Moving forward, I do think 45X was something that was early on. This is the advanced manufacturing production tax credit, which is targeted at certain components for the wind, solar, battery industries, critical element mining, and maybe a few other technologies as well, to bring really domestic onshoring the manufacturing process in the United States for those kind of critical components to these projects. Early on, there was fear that 45X might just be nixed altogether. The House eliminated it solely with respect to wind, and then also scaled back on the critical minerals. What happened now is it's just scaled back regarding wind components, And once again, Eric, this might kind of goes to like the established marketplace kind of things of that nature. But one thing to note is 45X was extended, and this is happening in a couple instances of the BBB. We are seeing some extensions, some modifications that are creating an additional cost. We're seeing it here with critical minerals. It's something that's kind of in the headlines these days. The clean hydrogen is one that I think is this is 45B. That's actually scaled back all the way to beginning construction by the end of this year. So that's another one that kind of falls in the wind and the solar bucket, which is, I'm not a technical expert, but is a little surprising to me given the fact that, clean hydrogen isn't one of those more established types of technologies. But I think it might have been one of the more debatable / controversial technologies that was included in the IRA at the onset.
Yeah, I think we even saw hydrogen hubs that were being set up by the Biden administration's DOE to really focus on economic development. And so there was a tremendous amount of dollars being invested in trying to set up a hydrogen economy, to put it broadly. But to see this, they're not in the headlines as much as seeing certain resi solar companies that are suffering in the public markets. But we have seen significant scale backs on investments already because of this, or pullbacks or bankruptcies or shutdowns of hydrogen developers already because this has been such a negative impact to their feasibility.
Yeah, I mean, it clearly eliminates any ability to make a pipeline of projects, and those few projects that can start construction, we'll talk about that in a minute, before the end of the year. And this is once again assuming the BBBA is passed. Only those developers that have the ability to start construction would be able to kind of lock in the PTCs for those projects. Moving down to 30C, this is alternative fueling stations. The credits there, but it's only available for projects that are actually placed in service. This is where it goes back to a placed in service deadline within 12 months. So we're going to kind of see, the transaction nature around those kind of potentially slip away a little bit for, EV charging stations, hydrogen fueling stations, things like that.
Yeah, and I think, Durham, to that point, just maybe take a step back from the tax credit transferability market, right? So as you noted, right, there might be some curtailment of wind and solar, credit eligibility in that the total credits available, and then the amounts of those credits may go down in the market. We might be losing 30C pretty soon, which was kind of widely speculated. And so as a result, when we think about the tax credit transfer market, obviously there's kind of a supply and demand kind of push-pull. Good news is, right, what you're about to get into is Section 45Z is going to come into play, which was not available for 23 and 24 tax years. So I think as we're monitoring all these potential changes, there is going to be a ripple effect in terms of supply and demand in the market, which will then ultimately impact the price, right, that our sellers are going to sell the credit for, and then obviously what the buyers are going to be paying.
Yeah, and that's a great example. 45Z is one of these things where it's being extended out to 2031. It's adding in a restriction on foreign fuel feedstock, which is actually something that's still being worked out, and we're kind of seeing that in real time with Congress right now. So where that ends up, it's still yet to be seen. And same with 45Q. I think this is another one that got extended. I think the main takeaway with 45Q is the tax credit piece, which we have here on the slide at $17 per ton, but that actually 5 times that, which brings it up to $85 per metric ton. And it used to be, and that's if complying with PWA, the prevailing wage and apprenticeship requirements, you get the 5X multiplier. So before the BBA, there was differing rates between enhanced oil recovery and if it was permanent carbon sequestration geologically into the ground. And it was the $85 rate, assuming PWA compliance, which all these projects will, for secure storage, when enhanced oil recovery was a lower $60 per ton. Now they're equal. So end game here is the BBB is promoting enhanced oil recovery with respect to carbon oxide. So that market is going to probably expand.
And one of the regulatory dynamics here, just to put it bluntly, I think is both the 45Z and the 45Q have, electoral groups that are probably more traditionally closely aligned with Republican parties and administrations, right? Your 45Q, a lot of the early movers and easy and fast players are in the existing oil and gas space because they have the type of infrastructure and building capacity and capabilities and existing backgrounds that can allow for 45Q transactions. We have seen companies that have, basically come out of oil and gas credits that have come out of oil and gas areas. And for 45Z, for those who are not familiar, this is, really most akin to renewable natural gas production. And so this is either coming from biomass, coming from landfill gas, or from dairy production. And so those are, agricultural districts that oftentimes have strong, Republican representation. And so I think that's why we're seeing some of that. We have two questions that came up that covered the same areas. Questions about standalone BESS and the storage ITC. So I'm going to jump back to slide 3, which was talking about the 48E clean energy and the ITC there. So yeah, Durham, do you want to just talk specifically about BESS?
Yeah, the good news with BESS and just any energy storage is those are not part of the haircut, as I'm calling it, under the BBB. So it's kind of business as usual, except for, which we're about ready to get into, the FIOC stuff. So with regard to battery storage, they'll still have to the 2033 date with respect to PTC, really ITC qualification. There is no PTC qualification. But if we skip ahead back to the end here, where the other kind of big highlight, kind of like in the Inflation Reduction Act with PWA, when that first came out, prevailing wage and apprenticeship was like, oh, this is a new concept. Oh, I see there's a little bit of details here. We'll figure it out. It'll be business as usual. And that's to get the full, 5X, which is, bringing it back to the original, full PTC, ITC. What the BBB is introducing is a new FIOC, which is a foreign entity of concern test. And there's really two, I put it into two buckets. One is kind of like an ownership, well, I should probably say 3 buckets. One is an ownership bucket where if there's foreign entities of concern that are owners of a project, not just directly, but indirectly, and it's based on percentages. So it can be, and foreign entities of concern are what I call kind of the naughty list countries, most like namely, Iran, China, and a few others. But if those governments aren't allowed to invest directly or indirectly into projects to qualify for these tax credits, which kind of has an initial, okay, I get it, not a big concern. But it's not even just a direct investment by those governments. Those governments, if they end up owning or controlling another corporation, it can spill through indirect ownership. And it really goes into, and I don't want to get into a lot of the details, 1, because they are kind of confusing. 2, we're still trying to dissect it. And 3, we don't know where these are ultimately going to land. So I don't want to plant seeds of concern just to find out that these are scaled back or go into a different direction. But the 3 ways they kind of look to disallow a PTC or ITC altogether is if one of those foreign entities of concern is a indirect or direct owner at least a 25% level, or cumulatively amongst multiple companies and other things up to a 40% level. There's some exceptions for publicly traded entities, but I mean, those are kind of manageable. Those kind of make sense. But then there's 2 other buckets that come in to play. One is if there is contracts that allow for those foreign entities of concern to control how the project's operated exclusively. So you could have, as long as you're not giving exclusive control to this foreign entity of concern, it should be okay. But if they have the ability to turn off, turn on, operate, or maintain the project, those can fall into the same bucket. There's also a similar concept regarding any IP that's necessary to operate the project if that is controlled by a foreign entity of concern, and they can kind of turn on, turn off the project as well. So it's kind of like, once again, getting the foreign entities of concern getting their fingers into the projects would disqualify it from the ITC. And the last bucket is probably one that has the industry most concerned about is material assistance, and that goes to a ownership, or not ownership, it looks at the equipment that's incorporated into the project, and those start to apply in projects that begin construction in 2026 or later, and in 2026, if you have 40% or more of the equipment manufactured by one of these foreign entities of concern, then the project wouldn't qualify. And it ramps all the way up to 60%. So you would have to have at least, and I might have said that backwards. You can't have more than 60% of kind of bad equipment starting in 2025. And then it goes all the way up to, I think, 2029 or 2030. It goes up to, you can't have 40%. So then it becomes a 40% threshold. So what it's going to require is a lot of diligence as to ownership, O&M agreements, offtake agreements, maintenance agreements, and IP, as well as the overall equipment mix that comprises a project might kick it out. And that's where battery storage, even though it's not impacted by the haircuts, because I think a majority of the suppliers, not only of the major battery components, but even of the subcomponents, come from foreign entities of concern, or at least might require some significant diligence as to whether they're foreign entities of concern. It might impact projects that begin construction in 2026 and later. So this is something that we could talk hours about, and we're still trying to dissect it ourselves. But that's something to keep an eye on. And the last thing is just kind of a word of advice. It's not certain the BBB is going to be passed. It's looking more probable as time goes on. And what is becoming certain is those projects that have begun construction will kind of safe harbor themselves to lock in the ITCs or PTCs at the 100% rate. And what it's looking at, like right now, although there's no certainty, is if that happens before the end of this year, projects will be in a good place. Naturally, there'll be a phase down in 26 and 27, but that might change. That might go back to the House version where it has to be within 60 days of passing. But right now, I think a lot of developers, a lot of owners of projects are looking to kind of lock in a pipeline, at least for the next 3, 4, 5 years through, and you'll have a 4-year construction window. I say 5 because you can do it again next year for a new kind of portfolio projects, but something to think about, whether it's the 5% expenditure or the physical work. With that, I don't know if you guys had any sort of additional tidbits regarding steps taken by developers right now to begin construction.
Yeah, maybe on the begin construction point, we saw kind of some similar action happen around, right? There was that prevailing wage and apprenticeship deadline of January 29th, 2023. So a lot of folks were rushing to begin construction prior to that date if they were over 1 megawatt. So we could see a very similar rush in terms of trying to make sure that you begin construction from a tax perspective. We do typically, right, Durham, see a lot of folks rely upon that 5% expenditure safe harbor because it is kind of more of a bright line test, but that physical work test is sometimes relied upon as well. And then maybe just real quick on the FIOC point, it's going to be interesting again from a tax credit transfer market in terms of kind of who that onus of kind of diligence and proving that the FIOC rules don't apply falls on. For a lot of our buyers, right, they're going to want the seller team to be very proficient in proving out that FIOC's not going to eliminate or potentially reduce some of the tax credit that they're purchasing. So I think as buyers are analyzing, right, which type of credit and which type of seller we want to deal with, obviously those FIOC rules could become pretty important to be analyzed and dealt with. Maybe with that, I'll kick it over to Eric for any further comment.
Yeah, one other thing, we did get a great question about the current domestic content table. So the IRS, in the last few years since the Inflation Reduction Act was passed, because there's the domestic content adder, they published some safe harbor rules that basically take they've given a table of what are the critical manufactured products, which are really the components of like solar, wind, and batteries. There's 3 buckets. And so those projects have finite tables of what equipment, and it only goes to the subcomponents of those 3 or 4 critical components of equipment. And that's where the kind of domestic content analysis stops, at those kind of finite lists of, let's call it like 5 to 12 pieces of equipment. And the good news is, when we go to the material participation for these FEOC rules, the way that the statute's currently drafted is the IRS is supposed to come out with new tables. But until they do that, taxpayers can rely on the domestic content tables. So we kind of know the place we're going to be playing with on the FEOC for material assistance, but only in those 3 technologies: wind, solar, and battery storage.
You know, I think from the side of what is going to be required, we don't know yet, right? Because we don't know exactly how that's going to be done. I think it was very clear that the initial House version was just unworkable, not clear enough. People didn't understand how to interpret it, and it was going to need some refinement. And I think what we'll see, hopefully, is a workable and sort of reportable solution. When we're always working on transactions, we want to ensure that there's the right amount of data available, so that in the event of an audit, buyers have what they need already from sellers. Buyers are oftentimes large corporations that want to make sure that they don't have to go back to a developer that may or may not be in existence to collect data. First of all, they want them to be in existence. They don't want to have a recapture on the initial credits, but they do want to make sure that they have all the data that they need, that they're not going to some small entity asking for that. And so getting that, from a FEOC perspective, is that the right type of certifications, the right type of cost tables, where are the accountants going to be involved? We've seen a lot of, prior to the final domestic content guidance, we saw a lot of OEMs having workaround solutions where they would have accounting firms do deep analysis of their supply chains for their underlying materials to do that type of representation and reporting that provided summary reports that were auditable under the event that they were needed, but in the event wasn't disclosing the entire OEM's cost basis of their materials and cost of goods. So I think it's going to be something that will be interesting here. I think the levels and thresholds that we're seeing are not the giant concern of, there's one person who owns whose uncle is a member of the Chinese Communist Party, right? Like that's not the point that we're seeing, but we are seeing that they're given the international supply chain that we have in the energy industry, this is going to be a major point of focus, but we just simply have to wait to see what the final legislation says before we can give clarity on that, I think.
Yeah, and one more thing is, just to make crystal clear, or hopefully make clear, is these material participation. So the composition of the project as to where the equipment came from, and did it come from a Chinese company or an Iranian company, for example, those rules only apply for projects beginning construction in 2026 or later. So it emphasizes the benefits to beginning construction in 2025, not only for 100% qualification, but also to avoid this material assistance analysis. However, the ownership from a foreign entity will apply starting the date the bill's passed in its current form. Also, and this is probably the item that everyone should kind of think about, the prohibition to allow a foreign entity of concern to turn on, turn off the project, or control the project, though, like through an O&M or an energy services contract or something else. Those rules apply also on the day the bill's enacted. So there might be a quick rush to go back and review all of those project level contracts to make sure there's not any sort of what I call false start kind of concept, which is unfortunate. But maybe Congress will fix this so that everyone's not in a tailspin trying to review existing contracts.
Yeah. All right. Well, we have some more specific things questions that I'll go ahead and address later, but I want to make sure we get to Brandon first in terms of buyer sort of pricing dynamics and how they're approaching certain types of deals. I know you had a couple slides on this, Brandon, so I'll just jump to those for you next, and we'll probably have some more BBB and deal-related comments at the end.
Yeah, sounds great. Thanks, Eric. So yeah, a question that we get a lot, right, both from buyers and quite frankly sellers too, to make sure that they understand the kind of dynamics for the buyers is how much of a tax credit, right, do you actually want to purchase, and what is the strategy, right? And in general, there's two main buckets of strategies. The first strategy that we see some buyers approach is, hey, we're just going to purchase a tax credit, right, to offset our current year liability. So maybe looking at the entire year's projection for what they think their total federal tax is going to be. Or for our larger clients, right, they might be looking at an actual individual estimated tax payment, right? So we make quarterly tax payments throughout the year. So for a calendar year taxpayer, they're going to be making payments on April 15th, June 15th, September 15th, and December 15th. And so what we've seen the large corporates do is time the purchase of the credit to align with their estimated tax payment. So they're basically replacing that tax payment to the IRS with the purchase of a credit for a lesser amount. And it's kind of a slam dunk because you're basically just keeping cash in your pocket. And obviously it's a tax-free transaction on both sides of the house. So the proceeds to the seller are tax-free, and then the spread to the buyer's tax-free. So this is a pretty simple example of kind of how that math actually works. So let's say the total estimated liability for a 2025 taxpayer was 10 million bucks. One of the common misnomers out there is you actually can't purchase a credit to offset 100% of your corporate tax liability. There's a general business credit rule limitation. The way that math generally works is you always remit your first $25,000 of tax, and then 75% of the remaining amount can be offset with the purchase credit. So in a scenario where you have 10 million of total federal tax, essentially about 7.5 million could actually be offset with the purchase credit when you're taking into account that 75% cap. So then if you purchased a $7.5 million credit at 91 cents on the dollar, you pay about 6.8 million for a $7.5 million credit. So then ultimately you're looking at around $675,000 of tax-free savings to the purchaser when you're kind of looking at that current year approach. So from a sell side perspective, when you're dealing with a buyer, it is important to know kind of what's their strategy. Hey, are they looking to purchase a credit to offset the entire year liability with that 75% cap? Or are they looking just to do kind of an individual estimated payment? Because then when we think about negotiating that term sheet and ultimately the tax credit purchase agreement, right, there are some timing considerations in that buyers aren't going to want to be prepaying their estimated tax payments. The other strategy that has become particularly popular of late is for much of the credits, there's actually a 3-year carryback, 22-year carry forward. And so what we've had some clients do, especially ones that have the available cash on hand, is they intentionally over purchase a credit for the current year. And the way the general business credit rules work is that they tell you to look back to prior years before you carry that forward. So for example, if you bought a 2025 tax credit and you bought more than you could utilize on your 2025 tax return, the rules would say after you file that 25 return, then any excess, you would look back to your 2022, 2023, and 2024 tax years to see if you could claim that credit on a prior year return, and then ask for a refund from the IRS. What's great about that is that there's actually a mechanism. It's called a Form 1139. It's a credit carryback form where you can do all 3 years on a single form. So for a lot of our clients that have the cash available, they are looking to basically recoup prior year taxes paid in addition to offsetting some of the current year tax with that purchase liability. So if you think about it intuitively then, right, instead of just purchasing a credit for 1 year, you might max out and try to purchase a credit to cover 4 years of tax. So again, hypothetical example, instead of purchasing a $10 million credit to offset the current year tax, maybe now we're purchasing a $35 million credit because we're going after a 4-year liability window. Again, for each individual tax year, we want to take into account that 75% cap. So assuming no other general business credits, you could offset about 26.2 million of that 35 million of tax. If you purchase a credit 91 cents, you pay 23.8 for that $26.2 million face value credit. And ultimately you get 2.3 million of savings. Obviously, a couple of key considerations with the carryback approach are the cost of capital, right? So you can't file the carryback until you file that current year return. So the later that we can time that purchase to the filing of that tax return, the more attractive the opportunity becomes. So for example, I think everyone on this call has done quite a few transactions. For example, we might still be wrapping up some 2024 tax credit transactions in the 25 year. some of our clients have basically gotten that 24 return done, sitting there ready to go, and then they've closed on the 24 purchase, and then immediately filed that 24 return, and then immediately filed that credit carryback claim. So when you can make the timing align, then it's a really slick strategy.
One question I had there that we get a lot is that carryback form equivalent to amending a prior year tax return? And does it open you up to re-audit on those areas? And then I have another one after that.
Yeah. Yeah, so it's not technically, 1139 is not technically an amended return. You actually can do some carryback to the amended returns, but most of our clients choose to utilize the 1139 process. If the carryback's over a certain dollar amount, it will go to joint committee for review. We have had clients that have actually gone through that process, and essentially what's happened is they just had kind of what they call a desk audit by the IRS, where they basically say, hey, we see that you've asked for a very large credit carryback claim. We provided the information related to the tax credit purchase, and knock on wood, at all those situations, the refund's gone through, and the IRS hasn't had any questions with that. So you're exactly right, Eric. There are some considerations. So depending on the dollar amount of the carryback, obviously the IRS is typically going to ask questions if you're asking for a big chunk of money back.
Yeah, and I think that's the point. So I think the JCT threshold is normally about $5 million for large corporations. Right. Is that $5 million per year or per total carryback? Like if you're claiming 3 years of carryback, the total's 5.1. Is that covering the threshold, or is it dividing by 3 year? Depending on how you divide that, I guess it would be under anyways.
From what we've seen, is generally the total carryback, right? So if you're going back in total over 5 million, then it's likely going to trigger that threshold.
And another thing that I've seen too, and I think the data I saw was pre-IRA. I'd have to go back and see if they've updated it. You know, something like 90+% or 95+% of JCT review is no change at all, right? Like there's not a huge amount of risk. The idea is you have great advisors such as CLA that are advising you through this process. The math is not wrong. You're going through a legitimate credit claiming process that you are able to carry back. It's just part of those concerns. The biggest thing that I've seen get either corporates or developers stuck on this carryback concept, because this seems like a great way to open up tax capacity, especially with corporations that have had a unique tax year that had significant liability that they didn't have this opportunity for prior to IRA, which we're getting towards the end of, but they had that at that point. Is the timing consideration, right? The fact that they need to file this with the current year. A lot of corporations are now thinking of this as they're looking at their 2024 extended filings, and they're saying, hey, we have $100 million from 22 that we want to go back and claim and incorporate into this. And we say, the sad truth of project finance is the $100 million credit probably figured out who its tax credit buyer was, at least 6 months ago, if not 18 months ago, right? Because it was getting built and getting finalized in construction. And so there's a timing mismatch still between some buyers' demand and sellers and sell side commitments. And I think this is what we see. We had a couple questions come in here, and I'm happy to talk about them further in terms of, what are you going to start seeing demand pick up for next year? And I think right now we're trying to figure out how do we get demand going right now in the midst of congressional legislation being passed.
Yeah.
Anything else you wanted to cover before we go over to our thing? Sorry, go ahead, Brandon.
No, I think that's exactly right, Eric. You nailed it. And I think that's right. I mean, if you think about corporate taxpayers, right, it's always good to be trying to think out, in the future in terms of current year estimated payments and even to 2026. I think what we saw practically from some of our clients, obviously with all the activity around tariffs and whatnot, for those impacted, right, they actually weren't sure what their 25 liability is going to be based upon, some of the tariff impacts, and then let alone 2026. Obviously, at this point in 25, a lot of folks have a darn good idea of what their 24 liability. So we get a lot of reach out literally every day almost of folks saying, hey, we just did our tax revision, or we have our draft return ready. Can you go find me a $5 million or $10 million tax credit, right? And obviously from a 24 perspective, that's really challenging just because the supply in the market is so limited. So we really try to encourage our buyers to try to start thinking to as much as they can. The farther in advance you can be thinking, the more supply there's going to be, and the more options in terms of tax credit purchases.
Exactly. Great. All right, we got about 15 minutes left, so I'm going to go relatively quick to make sure that we have some time for at least 7 minutes of questions over the next few areas. So in terms of like where we're seeing deals today, as I mentioned, basis is focused on tax credit transfers specifically. However, transfers can come from all sorts of types of credits, right? And so I think I wanted to dive through looking at the dynamics across these different types of credit types, and then also thinking about the changes in credit types from 2024 place in service versus 2025 and beyond. So broadly, Section 48 and 45 were the typical tax credits for investment tax credits and production tax credits that had existed in prior years, with additional sub-language being added to it from the IRA. And that existed for credits being placed in service through the end of last year. Now and beginning construction even. Now for credits that have begun construction this year, they now are under 48E and 45Y. And those actually have a very specific different set of guidance that we were all on pins and needles waiting for final guidance prior to the new administration, knowing that there was this army of very small army, but a very dedicated army of workers at Treasury that were publishing guidance and regulations. Those did come out just before the new administration took place, and so we were able to get that final guidance on 48E and 45Y. There are different structures and different considerations in terms of that, and one of the things that you'll have seen from Durham's slides earlier is there was not much mention of congressional changes to Section 48 or 45, and that's because those credits they did qualify for projects that met their criteria, but only up until that point. So all the sort of future-looking changes have been focused on 48E and 45Y because that has been the extension, the extended credit, which are called tech neutral, where they're broadly trying to just say, hey, if you're an investment tax credit, these are all the different types of technologies and sort of qualifications of a technology to be able to be tech neutral and qualifying for that. Now there's restrictions in the proposed BBB guidance that are restricting that, but broadly speaking, that's the difference between 48E and 48 versus 45Y and 45. In terms of the deal structures that we're seeing, we do a lot of direct transfers straight from a lot of distributed generation and people that are looking just for a direct transfer because they have a unique tax situation that they don't need to monetize depreciation, or they're not looking for a step up in basis. But for developers that are looking for step up in basis and monetize depreciation, the two main paths that we see are either structuring a typical tax equity partnership that allows you for the depreciation monetization, and then also in some cases there's a new universe of preferred equity investors that are out there, and we're very excited to be partnering with different preferred equity investors on these transactions, and bringing a solution that provides developers the ability to step up in basis to a fair value of their credits. Effectively, that preferred equity structure is where there is a minority investor that comes in and has an economic interest in the project that is for a set period of time, similar to tax equity, but we kind of look at it as tax equity light, and it helps the developer be able to have a higher tax basis because there's a value of the credits that's been deemed by an independent third-party investor, true third party, and then it's also helping them reduce their overall capital injection from the sponsor equity into those. And so I think there's around 10 or so investors out there in the space right now. We are seeing that they have different flavors of what they're attracted to, some to smaller credits versus others to larger ones. But for us, it's all about having specific developers that have different needs get met by different parts of the market. And I think that's one of the beauties of transferability is that we're seeing that it's out there, especially in the ITC space, where you have anything from a single carport in Arizona needing to monetize its $200,000 worth of credits to a giant hybrid solar and storage project in Texas that has $350 million worth of credits that are being deployed at the end of this year, and they're looking for that type of buyer. That's a huge universe and different types of buyers, and I think CLA probably serves both kinds of buyers there. But you finding the right type of buyer for the different type of credit can be a sticking point in a lot of cases. One thing that we have seen a lot of interest in, which I think is a good part of this American energy dominance story that we're seeing told by the clean energy industry, is the attractiveness of 45X credits. The 45X credits are the advanced manufacturing credits. those credits are broadly, very attractive to investors because they do not have a lot of the recapture or disallowance concerns that you would see from a ITC, and so they're closely aligned. They're under Section 45, so they're a production-based credit. And the diligence can be a lot lighter. And so really you're looking for qualification of, is this a manufacturing facility? What was the manufacturing process that took place here? And then finally, how much was produced and transferred title to, a third party broadly. And so that's a much lower threshold than digging into when did the construction start, what was the amount of value that was done, what was the eligible basis, what kind of credit is there, what kind of equity structure do they have, what are the back leverage or loans that they have that can cause all sorts of ITC recapture concerns. And so that's been the benefit that we've seen there for 45Xs. In terms of other technologies that are transacting, again, there was that mention earlier of 45Z being popular. There are some 45Q transactions that are happening out there as well. These are all really looking at spaces in terms of thinking of who are the right type of credits that are, sort of unique, nuanced spaces. There can be some pricing improvements, but we oftentimes see some buyers struggle with the technology difference to wrap their heads around something. Like most people generally know what a solar project looks like, but to understand the risks around carbon sequestration and leakage, or to understand the risks around renewable natural gas, and was it measured appropriately, or did it meet the GREET score that we're looking at now for 45Z? That can be some issues in the market that we see going forward. Moving quickly on, in terms of the spaces for the sort of sticking points that we see that are either commercial or legal, a lot of ITCs, because of all the recapture risk and just the sort of structure there, we see generally about at least 3/4 of investment tax credits requiring tax insurance. There's a robust tax insurance market, but it does have kind of significant minimum thresholds of premiums that can be a burden on smaller transactions. And so for smaller transactions, it is striking the right balance between, the developer, the guarantee, can they have a significant backer supporting them? And then lastly, do they have a structure in place that lets the tax credit buyer get comfortable? The challenge is smaller buyers are often smaller corporates, and then smaller developers as well for smaller credits, and so that ends up being a sticking point a lot of times.
Yeah, and Eric, to build on that with the guarantee, I mean, we see deals that include both a guarantee and tax insurance, and in my view, it comes down to the buyer's comfort. And they're entering into this kind of one-time transaction to purchase credits for the premium, so to speak. It's not like buying an equity that might have this unlimited return if you hit a home run in later years. It's kind of like a one-off deal. And so, it's really not fair for buyers to be taking, qualification risk regarding the credit. And that's what the insurance and the guarantee is there to kind of backstop from the buyer's perspective. So I think all sellers should be cognizant of the fact of, depending on their size, if they have a robust balance sheet, they can avoid the cost of insurance, where insurance can fill that gap if, the balance sheet might not be quite as robust for some developers or sponsors, and therefore insurance is the right product to help, make that transaction work for a buyer.
Yeah, and I think that's why you just generally see a lot of buyers who are especially kind of more risk-averse tax directors at large corporations say, hey, you know what, like, just let me get insurance. I know that it's there. It's something that I can lean on. I'm not going to face a giant tax adjustment because there's been some sort of disallowance or recapture situation here that I, as a non-energy investor, was totally out of my control.
Yep.
Another big thing that we were talking about before the call was focusing on place and service date risks. One of the challenges is, we are facing a world where the tax credit is when the project was placed in service. And so this is challenging for both types of developers. Many distributed generation developers oftentimes have place and service date that are all in Q4, kind of looking at the construction cycle because of seasonality in winter, and looking at when community solar projects are getting developed. We see all the time lots of project schedules, 15 project portfolios where at least half of them are going to be placed in service in the last month or two of the year. what that means for buyers is there could be significant risk for projects slipping into the next year, and therefore not being a credit that they're buying this year in the end. Even if they agree that agreement up front, there's a risk that they're not going to get the volume of credits they're expecting. And so that can be a challenge when they're decreasing their estimated tax payments and could face a penalty or interest for unpaid estimated taxes. Similar for utility scale projects, that is a risk as well, where those utility scale projects are looking for that tax credit offtake and the buyer to be there. But a large utility scale project may face major construction slippage during its time. And so that's where the sort of needing to build out a deeper market ends up being a pretty critical path for us in terms of having more and more buyers that have different types of flexibility or approach points onto these credits.
Just like what we see often is, a discussion of, if a project, it's a construction project, if it slips to the next year, naturally the credit's still valuable, it's still worth the same dollars, but it's in a different tax year. No buyer wants to be prepaying for that. And typically a seller will never ask for cash in advance, and that's just not going to happen. But it boils down to if the buyer's kind of offsetting their estimated taxes in advance of that placed in service date. And what it does is it accelerates the returns to that tax credit buyer. So it's not just that Brandon had that slide deck with a 9-cent discount. It's taking that 9-cent discount to maybe 12, 14, somewhere percent kind of net investment if you can start offsetting your tax liability in Q1, Q2 for a project that you might not pay for or credits you might not pay for until Q4. But then the seller has this dilemma of, how do you make a buyer whole for claiming a tax credit kind of early, knowing that the project might slip into the next year. Fortunately, we're seeing lenders step in with like travel loans and other things, kind of filling that cash flow need. And so it's allowing developers to sell later in the life cycle of the construction project. And that's helping to kind of fill that problem. But I still don't think it's solved fully. And so, Eric, I 100% agree. As this market develops, I do think it'll get more mature and they'll find more solutions that are equitable for both sides.
Yeah, and I think we're just approaching the end of the time. And I think I just want to I'll give myself 30 seconds, and then I think Amy, you, Brandon, and then Durham, final 30 seconds each to be able to go through this. So I think for us, right now what we're seeing is there is a lot of buyer hesitation looking at what's going to happen both to their own tax liability as a corporation or a passive qualifying individual, but generally for the corporations looking at the broader tax consequences. It's not just clean energy tax credits that are in the big, beautiful bill. It is a lot of different things that could impact corporate tax liability. And so there's a lot of buyers that are either focused on what the downside situation is. And so I think we're seeing some hesitation in the market right now. We, of course, still have many deals transacting. A lot of those deals are, projects that are near term or already placed in service that are looking to transact their credits. The farther out appetite, I think, is going to be picking up once the dust has settled out of this bill. But I think we're excited about what's going forward in the market there. Brandon, any final closing thoughts?
Yeah, thanks, Eric. Yeah, I think kind of one of the key headliners for us with the Big Beautiful Bill is obviously there's no direct repeal of transferability or Section 6418. So I think that's great news for both sellers and buyers, right? There was a little bit of fear, a few months back that could potentially be the case. So, again, there are ways via the tax credit transfer agreement to help mitigate risk for both buyers and sellers when it comes to change in law or maybe some of the uncertainty. And, good possibility in relatively short order here, we're going to have clarity on what actually gets passed with the Big Beautiful Bill, and then I think it's going to be full steam ahead for the tax credit transfer market. So maybe with that, I'll kick it over to Durham.
Yeah, I kind of go back to beginning construction. I think for what we're seeing with clients is making sure those building blocks for a successful project, for a successful tax credit, which leads to that successful transfer and successful financing. But focusing on presuming the BBB is passed, that we'll likely have till the end of this year. It might change, but likely to the end of this year to build up that pipeline of projects that will qualify for the 100% tax credits, which will then allow these markets to stay developed for the next at least 4 years, and then with the phase out of the solar and the wind, there'll still be the tax credits there. And then the other technologies, 45X, carbon capture, and the clean fuels.
Well, thank you, everyone. Thank you to the over 100 folks that joined us today. This is really exciting. We hope that we provided good information. Begin construction. Don't wait until January, and certainly don't wait until December 15th to email Durham about opinion letters around what would be the right threshold for begin construction. Each of our contact information is here below. And with that, thank you very much. Feel free to reach out to us with any further questions. And we look forward to continuingly robust clean energy tax credit market, despite whatever changes may be on the horizon. Thank you.
Thanks, everyone.